Okay, right. This is just a quickie. Now we're going to take a quick look at different types of ratios. So this is ratio analysis 101. So we've got on this side we've got liquidity. Liquidity ratios come from a balance sheet or what we call a statement of financial position, where we take a snapshot and we look at what are the assets and what are the liabilities within an organisation at any given day of the year. The first thing we're going to do is going to say what is liquidity. So liquidity is the ability of a firm to pay its short-term debts. So what we're thinking about is, do we have enough value in our assets in order to pay our short-term debts? Effectively, do we have any working capital? Do we have any money that is, do we have cash flow? Do we have money moving around the business that can be used to pay those debts? So we're going to take two figures from our comprehensive statement of financial position, our statement of financial position, and we're going to look at what are our current assets, what are our total current assets. Now, current assets refer to the concept of these are things that you own that are of value. That's what an asset is. And when we say current, we mean you're only going to keep it for less than 12 months. So think about it in terms of when you've got things like money that you hold in an organization or money that you hold in a bank, or a great example is stock or inventory. The other most obvious example is a debtor, somebody that owes you money who's going to pay you, but they haven't paid you just yet. Okay, so you know that money's coming, it's yours, you're not going to keep it for very long because once you've got it, you're going to spend it on something else, right? So current assets are quite liquid. It means that you can change them into cash quite easily and then use them for something else. So we're going to take our current assets on one side and we're going to compare that to what are our current liabilities on the other. Now, current liabilities are exactly the same. Short term, less than 1 year, but not assets, debts. A liability is just another fancy word for a debt. Money that you owe somebody. Okay, so this debt could be to a bank. It might be something like an overdraft. It could be a very short-term loan. It could be something like trade credit, where you are going to pay your supplier some money. In fact, that's what we call a creditor, right? People that you owe money to that you haven't paid yet. You're going to have to pay that bill at some point, but you haven't done it yet. And you'll have to do it in a short period of time. The only other thing is probably something like a tax bill, something that is hanging over your head that you haven't paid yet, but you are in the process of getting that organised. So here we have our current assets versus our current liabilities. Now, think about that. That's our current ratio. Let's use an example. Let's say we've got a current ratio of 1.5 to 1. And what we're actually saying there, what we're saying there is we have the ability to liquidate our current assets and pay our short-term bills. We are going to be liquid. We are going to be fluid. We have cash flow. We have working capital in the business that will allow us to pay our short-term debts. On the surface, it doesn't look like this business has got any issues in terms of cash flow, in terms of too much debt or anything like that. It can pay its debts in the short term. But, and this is the big but, there might be a problem here because if we use what's called an acid test ratio, which is a much more accurate way of measuring liquidity, what we do is we have our current assets take away our inventory and we compare that to our current liabilities. Now, what are we saying there? Well, what we're saying is we cannot guarantee that we can liquidate our stock. That money is only going to be useful to us to pay our bills if we can liquidate it. If we can't sell our inventory, then we may have issues in terms of our short-term cash flow and our liquidity in the business. So imagine a scenario where stock takes up quite a large amount of this figure. We might be in a situation where it might be 0.75 to 1. What are we saying here? This is a big problem. We're saying we do not have enough money in the short term to pay our short-term debts. We've got a cash flow crisis unless we can sell our inventory. So what looks on the surface like a pretty normal scenario can actually turn quite nasty if we start to think about what happens if we can't sell our stock. This is the concept of liquidity. That's how we're going to measure it. That's how we're going to use a ratio to figure it out. Next, profitability. There are 3 types of profitability ratios. Really simple stuff. Gross profit, I'm going to just put GP, gross profit, divided by sales revenue times 100. All we're saying is how much of our sales revenue is gross profit. But gross profit is a terrible measure of profitability, right? Because it doesn't take into account some of our business costs. It only takes into account our direct costs, like the cost of raw materials. What we want to think about is, what about the expenses? So, if we've got our gross profit margin, we can take off our expenses until we get our operating profit. And then we use our operating profit, I'll just call it OP, divided by our sales revenue times 100. Now this is a much more accurate measure of profitability, right? Because we're taking into account our direct costs, like raw materials. We're also taking into account our expenses, things like wages and rent, advertising costs and all these things. So we've got a much more accurate measure of profitability. However, we're not taking into account everything. So we're going to take into account the other things like dividends and tax and all this stuff, until we get to a point where we've got our profit for the year. And I'll call that, it's often called net profit, but we'll call it profit for the year. We're going to divide that by our sales revenue. I'm going to times it up by 100. And what that does, it tells us what percentage of our sales revenue is actually profit. Again, what are we going to do with this information? Well, we do several things with it. So we can compare it to previous years. That gives us some form of benchmark. Say, are we improving as a business? Are we becoming more profitable? We can compare it to our competitors and say, is company A more profitable than company B? We can show it to potential investors, and we can say, look, maybe you should be investing in our business. We're really profitable. We could do all sorts of information with it. We could do all sorts with this information, right? So we can give it to shareholders, and we can provide it to managers who are tasked with improving profitability in the business. So there's lots of reasons for doing this. This information comes from the Statement of Comprehensive Income, or previously known as the Profit and Loss Account. And this information here comes from the Statement of Financial Position, previously known as the balance sheet. Okay, that is the quick summary of liquidity and profitability ratios. Okay, thank you.